Thank you everyone for joining. We will probably have people slowly trickling in. We had a lot of folks sign up, so that's totally fine. This is being recorded. You'll be able to watch it on our website anytime. So if you missed the first few minutes or anything like that, or you want to watch it again, it will be available. As you all know, today we are talking about um, valuation, right? Valuation for employee ownership transactions and why it's such an important component of all employee ownership transactions, whether you're considering an employee ownership trust, what we call an EOT, management buyout, or what we call an MBO, or an employee share ownership plan, what we call an ESOP. Evaluation is part of all of those. And so understanding kind of how one goes about evaluation, the guiding principles, how it's used, and how purchase price can be structured around that and be impacted by it is really, really important for anyone who's considering one of these transactions or who's considering buying part of a company in one of these transactions, right? For owners and potentially future owners. Um, Perfect. So I'm actually going to stop sharing my screen real quick. I'd like to introduce our speakers so you can see them while we're not staring at the slide. So we are, first I'll introduce our speakers and then I'll go over the agenda in case anyone wants more details of what we're talking about. So first of all, big thanks. Our speakers today are two outstanding professionals who have tremendous experience in the employee ownership space. And we're very, very lucky to have them. Actually, I was very happy and surprised when they were both available. We're really, really lucky. Melanie Russell is the founder and president of Kalex Partners. Melanie has a tremendous number of designations. I couldn't even possibly begin to list them. Is incredibly qualified. And she's, again, the founder of Kalex Partners. And Kalex Partners has offered expert valuation and forensic accounting services since 1997. It is also a long-standing member of Employee Ownership Canada, and they have significant experience, as I mentioned, in the employee ownership space. So a real value add for this conversation, someone who's going to shed a lot of light on the valuation side. Melanie herself has been practicing in this field since 1985. She holds the Fellow Chartered Business Valuator designation along with several other designations, and has qualified many times as an expert witness for valuations. She's done that in front of the Ontario Superior Court, the Federal Court of Canada, the Supreme Court of British Columbia, and numerous other professional tribunals. So she's going to be a fantastic wealth of knowledge for this conversation. We also have Candace Hartwell, who is a partner at Veer Business Advisors. And Veer is a Canadian advisory firm focused on sell side business transactions, so supporting owners who are looking to sell and with significant experience in employee ownership specifically. Veer is also a long-standing member of Employee Ownership Canada, and again, significant experience in this employee ownership space. So incredibly lucky to have these two here. Candace has a background. Again, Candace also has several very impressive letters at the end of her name, including, I'm pretty sure, a CPA. Um, and she has a background that spans commercial lending at Business Development Canada, exit planning, hands-on transaction advisory, and she brings a practical owner-centered perspective to every deal that she works on. So again, very fortunate to have these two here. We plan to have them present for about 30 minutes. I'm going to share my screen again and show everyone the agenda. Here. All right. We're going to have Melanie will start. Melanie and Candace will speak for about 15 minutes each. Oh, I love this little bar. And get this guy to go away. And Melanie specifically is going to talk about fair market value definitions. So if you see FMV, that's what that is, fair market value. Kind of definitions, some principles, and some other important details for employee ownership. She'll talk about components of value, valuation approaches, and then some kind of lessons from the trenches and key considerations for folks moving forward with valuations. And then Candace is going to go one step further and talk a bit about structure of employee ESOP and EOT transactions. So again, employee share ownership plan or employee ownership trust transactions. Still can't get that guy to go away. She's also going to talk about how purchase prices are paid. So there's multiple different ways that a business sale can actually get paid out. And then where a business sale depends on the cash flow of the company to pay the owners who are selling, how the price is paid out of cash flow is a really important thing to consider. which is particularly important for employee ownership trusts because that's how those transactions work. And then we're going to leave lots of time for Q&A. I'd love it to be 25 minutes, but it should be at least 20. And we would ask if you could please hold your questions to the end. Feel free to use the chat function, but also the hand raise function. We love people putting their faces on the screen and asking their questions live is lovely. So please feel free to do both of those at the end. And also just note that please don't take any of this for professional advice. If you have specific questions about your situation, please consult your tax and legal professionals. Yeah, just want to put that out there. So with that, I will stop sharing my screen and I will let Melanie kick it off.
Excellent. Thank you. So just give me a second and I will get the slides on. So thanks very much for that nice warm welcome. Hopefully everyone can see these slides. Now, first of all, I don't want to scare you. I've got like a lot of slides here, but a lot of it's just for reference. I am not going to speed talk through 50 slides or whatever. It's just, I'm going to point out a few of them and leave you with a little bit of information. So I assume the slides are going to be shared. Is that,
We
or
can
if,
absolutely do that. Yep.
or yeah, feel free to reach out to anyone to get a copy of them. Happy to
Wonderful.
do that. So here is me. So you guys can see what we're covering. And I think we already sort of talked a little bit about that. But so let's talk, why does value matter? So valuation isn't just a measure of value, but it actually affects why it's relevant in employee ownership situations is it affects employee behavior and outcomes. And that's the whole beauty of it. It's one aspect of trying to motivate employee behavior and work towards growing the firm. So I've listed a few purposes of or uses of valuations here, and it sometimes depends on the structure, right? Is it an employee share ownership? Is it an EOT? There'll be different points in time that evaluation is needed or not needed. And for example, if it's an employee share ownership, then you may have a regular valuation need so that as issues happen, someone retires, someone comes in, there's a death, there's a termination, then you've got a transaction, a value to base it on. EOTs, not so much. You're going to generally be doing those valuations at the beginning. So it's often can be a starting point, and you may not even know what the plan is, but you're trying to decide what to do and whether to go ahead with an employee ownership situation and if so, what form. So that can help you at the beginning, can help the vendor understand what they're getting. It can help if it's an employee share ownership situation, possibly to help with a shareholders agreement formula, etc. So many different purposes, and EOTs, there'll be specific purposes because you're not necessarily doing a regular evaluation. So I'll summarize some of the lessons I've seen through the employee ownership situation over time. And one of them is that value can drive structure, but structure sometimes evolves over time. And I've found that the financial piece, which is the area I like to play in, is important, but the communication and the softer issues around that are often much more important than just the numbers. Important to realize the human reality of it, and important to recognize that value issues do drive behavior. And employees will act differently when they understand the finances and the value than if they don't. So education is very important, comes along with the valuation piece of it. It usually is a good starting point, but if you're in a situation, especially in a share ownership plan, you've got to recognize that value doesn't stay stable. So you do evaluation at one point in time. In the next day, it may be similar. It may not. That 3 years it may be fine. 3 years it may change. So value is at a point in time, and it does change, and that's important to recognize. Um, and the devil is often in the detail, and just making sure that the evaluator understands the situation, understands what the plan is, because that can affect what the value ultimately comes out to be. And we'll talk a bit more about that. Um, So value definitions, there are a lot of different value definitions. The one that valuators most commonly use is the tax one that actually arose when valuations became a thing in Canada, which was 1971, probably well before most of you were born, but um, this definition showed up in the Tax Act, and that's typically what we use. So it's a reference point for us, and it's supposed to be we're pretending as if someone was at the table negotiating to buy the business, and that's supposed to dictate value. And then there's a few parameters around that. You can, of course, use other value definitions, but just make sure you consult with a evaluator if you want to go beyond what that value definition is. The next few slides are just more educational if you're really interested in some principles of fair market value and what makes up that definition. So I'll leave you with the next few slides just to take a look at those. Um, and some of the rules, the slides that I'm going through now, these are some of the rules for valuators. And an important one is what I mentioned, that value is at a point in time. And it's a challenging one because usually when you're doing a valuation, time has passed. Like you may be doing it last year end, but things have happened since. But in theory, you're valuing at a point in time where you're not supposed to know unless it was knowable at the time, um, what is happening now. So it's a funny principle, but value changes over time, right? Whether it's because interest rates change or because market conditions change, whatever. But that's one of the things valuators look at is what should we know? What do we know and what should we know? And everything is based on future expectations about cash flows, about where the company is headed. That's what is, it's kind of like if you're going to pay money for something, whether it's a Government of Canada bond or a TD Bank share or the share of a small business or medium-sized business, you're paying based on what you think the future cash flows are going to be. And so obviously the market dictates that. So as conditions in the market improve or change, the values of something will change. Okay, this slide just talks a little bit about key things that if you engage a evaluator, what they're going to want to do. They're going to want to understand what's the valuation date, what's the structure you're looking at, what's to be valued, is it everything, is it part, is there any governing mandate, is there a shareholders agreement that's already in place that says here's how you must do the valuation, who's going to look at it, is it is it the lawyers, is it CRA, is it the trustee in an EOT, what report level you want, fees and things like that. So I mentioned there's different types of valuation reports. So I would say in most employee ownership situations, we typically go with what I'll call the medium level of diligence. So we've got calculation, we've got estimate, and we've got comprehensive. And there's sort of the lower level of diligence, the medium level of diligence, and then the high level of diligence. So that's one of the choices that you have to make. But I find typically we'll go with that. Most people want to go with a moderate level of assurance or comfort on the valuation. Um, the high level can be very expensive, especially if financial statements aren't audited. It may be a little more challenging. And sometimes people aren't comfortable with that low level, so they want something higher. So that's one thing to just recognize that costs and timing and everything will vary depending on the level of report that you're selecting. And it depends on the situation. So this slide is just talking about you look at the situation, understand the different levels, understand who the users are, and then be in a position to pick what the appropriate level of valuation report is. I've got some slides at the back of my material that just go, if you do go through evaluation, I don't know how many of you have gone through evaluation or are going through evaluation, but there's certain amount, and sometimes it can seem extensive, that evaluator is going to require. So I've got a list at the back that just gives you an idea of what to expect if you engage evaluator in that first laundry list of requests that they're going to ask about. So just what is value? Let's have a couple slides on what really is value. It's what are future cash flows expected to be based on the valuation date? How risky are those cash flows expected to be? What are alternative rates of return? And what is the balance sheet or financial position um, of the entity that you're looking at? So all of those factors come in and you kind of mix it into a pot and you come out with this magic number that has some science to it, and it has it's a mathematical science to it, but it also has a fair amount of professional judgment and subjectivity. Um, and so there's also a few slides in here about how do you come up with those future cash flows. Because if you are involved with a smaller company or mid-sized company, doing projections or forecasts or budgets um, may not be done very commonly or may not be done with a lot of scrutiny. So evaluators are often starting with historical results and taking a look going forward, what um, what might be an indication of the future cash flows in the absence of having reliable projections. And then the multiple. So one of the aspects of future cash flows, the other important input is the multiple or rate of return, which it looks like a black box. And again, there are some scientific objective reference points, but it is a lot of judgment as to what someone would pay or what kind of payback they will expect. If they put their money into this business, are they expecting to get repaid within 5 years, 2 years, 10 years, whatever, assuming they're actually making a purchase. And then the financial position. So the idea of if you're looking at a business that has a bunch of extra cash that's been accumulated over the years and that's staying in, that company should be worth more than the exact same company that has that extra cash stripped out before a transaction happens. So the financial position of a company also has a significant impact on the value. Okay, so some cautionary tales. I think I just have a few more minutes left. Um, and I'll just tell you a few of my cautionary tales, and a few of them I've expanded on here. The wrong starting valuation. And I've had situations where it was an employee share ownership situation, and the employees actually bought in, and they considered it to be part of their compensation. So they were, for a while, getting regular dividends, regular returns, in addition to their salary. And then the company came across hard times, and those dividends stopped, and they stopped for a long time, and it created a major backlash, and it ultimately went. There was threats of lawsuits, etc. Part of it, I think, is because the employees, shareholders were not properly educated about what was involved. Part of it also was, I think, an overly optimistic value when people bought in. When I looked at it, I think it was a little too high. So that starting valuation is really important. So you can get into affordability mismatch if you're dealing with an actual share purchase situation. Behavioral failures when employees, as I mentioned, don't understand the risk, especially if you're actually holding shares. It's different than having a job. It's a share. You're holding a particular instrument that could go up and it could go down in value. And sometimes there's an issue with the cost benefit involved in the process. Um, so this was my little example of this revolt among the shareholders. And in this case, I remember going to the annual meeting of the shareholders, and I just felt awful because I was thinking that these shareholders, they're very upset, but the company is also relying on them to operate the business. So you get into a mixed situation where that the shareholder views bleed over into the employee views, and they get mixed up. Um, so if you are a couple things, one last thing I'll mention, I think, on the idea of a valuation formula. So if you've got an actual ownership plan where someone's buying in or being bought out if they leave, um, often what we do is we'll set the valuation initially, and then people will ask, well, can you do a formula to make it simple? I don't, much as I like you, Melanie, I don't want to come back every year or every time somebody leaves or dies or gets injured or whatever happens, and they need to be bought out or they need to buy in. So we'll do a formula and a simplified formula. And the benefits of that, it's a cost benefit issue, but you can start to sacrifice accuracy in the valuation for that cost savings. And you may potentially get into CRA issues. So that is something to consider if you are into share ownership, and something to talk to your valuator about. So just as a summary, valuation isn't just a mathematical exercise. It can shape behavior. Um, and the valuation needs and the approaches need to evolve with the business. And as I said earlier, transparency and understanding are critical to success in any employee ownership plan. All right, there's my contact details. I'll pass it over to Candace and I'll unshare.
And I was on mute. Thank you so much, Melanie. We'll make sure your slides are posted with your contact info as well. Thanks so
Awesome.
much. That was great.
Thanks, Melly. And can you see my all good here? Great. So I'll just dive right in. Thanks for taking that over, Melanie. And so where we're structuring our part of the conversation here is now, how do we take that valuation and then use that to get to the ultimate actual price, the purchase price that is paid for a business? So to jump in, here's a little case study of acquiring a business. This is a very vanilla type transaction. We are only limited by our creativity and how these can be more complex. But in a simple transaction, we'll have the current owners, they own the operating company, all the shares of the company. And in this scenario, we have an employee group, or potentially all the employees buying the business from the current owners. Typically in a transaction like this, the employees will incorporate an acquisition company, essentially a holding company, with the stated purpose of acquiring the shares of the operating company, or OpCo as it's sometimes called. And how that transaction works is the holdco will pay the purchase price, whatever that purchase price ends up being, to the former owners, the sellers, in exchange for the shares of the operating company. Over time, this can actually look like the holdco being amalgamated with the operating company over time, subject to tax advice, and desired end state could be where the employees eventually own 100% of the operating company. Awesome scenario. Slightly different for an EOT transaction, where rather than a holdco being incorporated, an employee ownership trust is formed, in which the employees become beneficiaries of that trust. The EOT itself is then the entity that purchases the shares of the operating company, and in exchange pays the purchase price to the seller, maybe multiple sellers or one, and that purchase price is paid in a variety of ways. And so for the current owners in the room, they might be thinking, all right, let's see how this magic happens. How are purchase prices actually paid? In general, for employee ownership transactions, including EOTs, one of the ways purchase prices are paid are cash on closing. And where does that cash come from? It can come from one or two broad sources: equity and debt. In a non-EOT transaction, equity can come from the buyers themselves. And that equity can be deferred bonuses we've seen on a few management buy-in deals. It can be the personal savings of the employee group, personal loans. Perhaps they go to their personal bank and borrow funds. It might be a home equity line of credit. I've thrown in rich uncles because we've seen that on a few deals, perhaps some co-investors or coins they find, around the house. But in terms of debt, two sources of debt, and I'll get into the second, but for cash on closing, the buyer group also has the opportunity to explore whether they can borrow from a bank. We know BMO is quite active in this space as well. And how is that bank debt structured? It's typically structured as using the future cash flows of the business being purchased to service those future debt payments. It's paid out of the future profits of the business. But the bank is going to look at a number of different factors to determine whether the business and the borrowers are bankable. And if so, how could that bank loan be structured over time? They'll be considering, okay, what kind of collateral or security is available? Does the business own equipment or property, equity? How much skin in the game are the buyers putting in? Not relevant for an EOT transaction, but very relevant in the scenario where it might be a key person equity plan or even a broad-based ESOP where employees are buying shares directly. They're also going to look at, who's going to guarantee the loan if the business itself can't pay that debt. Are there other related companies that are willing to provide a corporate guarantee? Very often for employee purchases, non-EOT, that the employees themselves will provide personal guarantees. So then the bank is going one step further and looking at, okay, what is the credit history of those individuals? What's their net worth? And then very importantly, they're considering the cash flow of the business. How volatile is it to economic shocks? What's the business plan? And do we have faith in the management team and leadership team and perhaps the exiting owner to make sure that they can execute on the plan? Because the bank is looking at making sure they can get paid over time. A note which I've brought up a few times. So in EOT transactions, very unique that the EOT employee beneficiaries are not expected to pay to come up with any funds directly. In those transactions, truly the business is using personal or the funds from the business itself, which is the employees working in the business, to pay the price over time. And what that is called vendor financing. The vendor or the former owner of the business is becoming another type of lender, the bank. So it's funds paid over time to those sellers. Those funds could have step repayment terms, sometimes monthly, quarterly, annually. They would have an interest rate. They would also typically have some form of security, similar to what a bank would require. Security may be things like a claim over some of the assets of the business, the opportunity to get the shares back, perhaps, if the business isn't able to finance the vendor financing over time. There's really a lot of opportunity to make the vendor financing quite flexible based on what the employees and the vendor are looking to achieve. It can be based on certain profitability in the future. It can be structured that if the business has a bit of a slow period, the vendor may be willing to accept lower payments in those years. Whereas if they have a year where they blow it out of the park, then the buyer group has the ability to accelerate some of those payments. Both parties, the buyer and the seller, need to be really aligned on what those future scenarios look like to find a win-win scenario with structuring these vendor finance loans. And I threw in a couple of AKAs, vendor financing. We call it VTBs in Canada, vendor takebacks, also seller notes, prom notes, a big fat IOU on a lot of these employee ownership transactions. For EOT specifically, vendor loans can be structured. And so this is sort of the sobering reality that owners need to be aware of the expectation when they are considering an EOT. Yes, it is possible that these repayments can take quite a bit of time. They're structured that for tax purposes, they can be up to 15 years. Typically, in ideal scenarios, those vendor loans are structured and expected to be paid within 5 to 10 years using the company's cash flow. So the real trade-off for the vendors is, okay, I'm not going to get a lot of cash on closing. It's potential if the business isn't able to borrow any funds from a bank, they might not actually get any cash on closing. But if they're willing to be patient and receive funds over time with a good interest rate, then the trade-off, especially which is exciting now, is this permanent $10 million capital gain exemption, which the business and vendor does need to qualify for. So an asterisk there, it is subject to tax advice to confirm that the vendor would be eligible to participate in that capital gain exemption. But the incentive and the spirit of the capital gain exemption for EOT transactions is to reward the vendor for their patience and being willing to finance a lot of these EOT transactions that are designed to be over time. But how do you structure a business like this? It's a great question for Melanie. When you're looking at a business that has fluctuating performance, perhaps in some years even negative earnings, we can take a nice little neat average of how past cash flow has been. But what if the deal is structured in a way that is based on those averages, but there are future scenarios where they might have years where they're unable to meet those future debt payments? And so this is part of the negotiation where we use the valuation as an input to determine what is the eventual purchase price that is paid. And a big part of the valuation is understanding what are the assumptions that drove that value, that formula. When it went into the black box with Melanie's teams, what key assumptions did they rely on? And do both the buyers and the sellers agree on those assumptions? There are a number of things that can impact the future likely cash flow of the business. And here's a few stories. Maintaining past clients. We worked with a business where more than 50% of their sales came from a very reputable client. They were not price sensitive. They were a long-term client. They did excellent work for them. And the current owner saw it as a huge asset that they had this long-standing relationship with this customer. But the potential employee buyer saw it as a big risk. If that client were to shop around for another supplier, or if they were to stumble on hard times themselves, then that would have been a huge impact on their future cash flow. Retention of key individuals. Are there certain people that have certifications in the business? What's the succession plan look like for those key people over time? A supplier line. We had one where the business sold a very unique product to a number of municipalities, and about 40% of what they sold was this exclusive supplier line. And the supplier, once they found out that the current owner was considering selling their business, they were very much concerned. Would the new ownership group maintain the same type of relationship with the supplier? If the supplier decided to shop around for a new distributor, would the company be able to find a replacement? Another one was a different type of distribution business for cost structure. They've been in business for over 50 years and had a handshake agreement with their OEM about the product they sold. And when they found out that the current owners were planning on selling the business, the OEM said, okay, that's great. Over 50 years, we've actually modernized our distributor agreements. And the really nice little kickback you've been getting for the past few decades is actually going to go away. We need to standardize to align with all our supplier distributor agreements. So after a sale, the business was going to lose about 10 points on their gross margin. Securing new work. Another client we worked with was bidding on a huge project related to the Trans Mountain Pipeline. What happens if they do or do not get that project? Another two is understanding the capital equipment and the cadence for replacing that equipment. A business we had worked with hadn't reinvested in their vehicles for the last 8-10 years. Well, they were all coming up on an expiry. What does the replacement and the cash flow need to look like to refresh, not expand the fleet, but simply to refresh the existing equipment they have? And the exiting shareholders themselves. Often if we hear an owner say they work 30 hours in a business, very likely they're extremely efficient. And that 30 hours in the business is probably the equivalent of perhaps 2 full-time employees, perhaps more. So how does that all factor into what the future state will look like under new ownership? Oh, let's see. And so when we get these differences in valuation perspective based on those different assumptions, but we have parties that both still want to do a deal, we have the opportunity to get really creative with what we call earnouts or contingent purchase price proceeds. They are parts of the purchase price that are paid in addition or perhaps clawed back in the future based on the items that the vendors and sellers are perhaps having disagreement about. So it can be, hey, if we did get the Trans Mountain pipeline in 8 months, then the purchase price will be increased accordingly. Versus if you do lose the supplier line and lose a couple of key customers because of it, then the purchase price part of it is clawed back over time. And again, we're only limited by our creativity in figuring out what metrics are used to determine whether the purchase price should be increased or decreased. They can be financial based off of revenue or maintaining or growing gross margin or earnings. It can be a project based, like being able to renew the lease within 2 years at a certain rate, getting that big project. And also retention, especially important in scenarios where the sellers are looking to exit sooner. If they've promised a 12-month transition period, that's awesome. But if they decide to boot it to Belize after 2 months, then perhaps there's some recognition for that and how the purchase price is paid.
Candace, I'm going to chime in.
Yep.
This is amazing, and I wish we had more time, but we should move to questions in the next minute or so, if you don't mind.
Great.
But
Great.
this is fantastic. I really do wish we had more time.
This is just re-summarizing what I've said already. The fact that owners need to be aware that if you're selling to an EOT, lots of understanding about how future cash flow is paid, where that cash flow will be needed, not just to repay that vendor loan over time, but where it will be needed in the business for continuing expansion, maintaining strong balance sheets. And in terms of general winning conditions, especially for EOT transactions or employees buying the company, we really look for that strong, stable cash flow, defensible market position, modeling to be able to understand what those different scenarios will look like. Huge importance on financial literacy. I know Melanie brought it up as well, understanding where cash is used and will be needed in your business. And then the vendor's mindset. They're willing to be patient to keep more cash in their jeans. They trust in the competence of the management team to be able to ensure they get their cash over time. And they're willing and see the employees as the optimal stewards of the business. So did I beat the timer?
You did great.
Okay, great.
That was so great. I wish we had more time. That was awesome. That was really great. We need to make these webinars longer. So we'll open the floor to Q&A. I think that, Charlotte, maybe we had one question that came from the chat.
We had two in the chat. So the first one is to Ali Saleh. I apologize if I just butchered your name. I apologize. Your first question was, who takes ownership of any IP? And I'm assuming that was directed to Candace, considering the time it was asked.
The ownership of the IP?
Of any IP, yeah. In a transaction, I'm assuming. Ali, feel free to jump in and elaborate on your question.
Yeah, correct. If there is any intellectual property, copyrights or trademarks or patents, who takes the ownership of that?
Definitely. It's assumed and part of the due diligence period to ensure that the company itself does indeed have the right and the ownership of that IP. And assuming they do, then yes, that would be included with the company. So when the employees buy the shares of that company, it is assumed it will come with that IP. And in the purchase agreement that documents the actual purchase of the company shares, it will specifically list in one of the attachments or schedules to the purchase agreement the IP that the company is assumed to have owned.
So is that transferred to the trust then? The
It
ownership?
will remain with the company, the operating company itself,
Okay.
and then the trust owns the shares of that company.
Okay, got it.
So slightly nuanced.
Okay, thank you.
I'll just add one comment. There's nothing wrong with if there's some IP that gets stripped out or reorganized somewhere else, right? It doesn't. You make a decision. Does it stay with the company, or do you want to do something else with it and transfer it to another company? So it doesn't have. You can make a choice where you want that IP to go.
Thank you. Thanks. Thank you.
We had one more question in the chat from Mike G, who asked, in a non-EOT situation, I assume deferred bonus or deferred dividends for employee share purchases would be considered taxable by the CRA? Question mark. Any comments? And Mike, feel free to jump on camera or open your mic to elaborate further on your question as well.
Do you want me to try that one, Candice?
Sure, go for it.
So first of all, I'll speak for Candice and I. We're not tax people, so just always consult your tax advisor. But in general, anytime you're getting money out to an employee for whatever purpose, it's going to be taxable. Now, that doesn't mean you can't do some structuring with loans, but and maybe there's an forgivable interest, and that may be included on their T4, but whatever. You just make sure you consult with a tax advisor on that. But in general, money going out is generally taxable.
If anyone wants to, feel free to use the hand raise function or perfect. You've got right ahead of me there.
Yeah.
Apologies if I mispronounced your name. Massey?
Massey, yes.
Massey.
Great presentation. First of all, very rich. I've learned a lot, tried to take some notes as well. My question is, do valuations have a role beyond the initial transaction? Like in the lifetime of an EOT, is it important to maintain them or refresh them?
Do you want me to jump in, Candice? And you, okay. So I would say generally not with EOTs, unless you're restructuring. I mean, it's possible that you're restructuring because the employees don't own the actual shares. The trust owns the shares, right? But there might be a restructuring or something that might give rise to it. In the non-EOT, that's usually when you get into more regular valuations, whether it's annual or based on trigger events.
Thank you.
Hello. Hi, it's Barry Crows. Question to either one or both of you. If you have a net profit for one particular year, which was the last year of your business, is it helpful or beneficial to mention the fact that in that time frame, 2 vehicles were bought with cash? In other words, you had more profit, but you used it to buy 2 more vehicles.
Do you want to go?
Either one.
Yes, sir.
Go for it. Proper accounting should hopefully not impact the profitability if you make a capital purchase like that. So it wouldn't be an expense when you buy a vehicle. It would have been a capitalized transaction.
And I guess that might lead to one of the things in valuations is, as Candice referring to, we consider discretionary cash flow. So if you've got a business that has not kept up with its capital expenditures, and another business that has hived off a lot of its retained earnings and used it to invest in capital, you might look at that historical cash flow and say, well, the one that's been investing is worth less because the cash flows are less. But in reality, that might be worth more. So we like to look at it after capital expenditures and just make sure, because if you buy a company that has not kept up pace and then you have to spend a whole bunch of money getting up to speed, that's kind of a hidden liability that hopefully you find on diligence before Candice comes and finances that business.
I was younger, many moons ago. Goodwill was very much part of selling a company. Is that still a major factor?
Absolutely.
Yeah, the goodwill in valuator and lender and M&A advisor language is really everything that is the soft assets. So all the cash flows that are generated because everything comes together, and that can be wonderful clients like the ones Candice referred to that some may think is wonderful because they're large, they're reliable. Others may think, oh dear, you're relying too much on one or two clients. But all that good employees, IP that was mentioned, the whatever the IP is, software, patents, whatever. So all that soft stuff goes into the goodwill. And lenders recognize that it's not just those hard assets. It's not like your automobiles or the CNC equipment that gives rise to future cash flows. It's a lot of this other harder stuff to put your fingers on.
Okay, thank you.
We have a question in the chat. Ooh, do you want to show this guy? I'll read it. Do you not need to revalue when current employees are selling their shares in the EOT to new employees? So I'm gonna actually jump in. I'm gonna add a link into the chat to our we're trying to get these on our website, but for the moment they're not. We have a YouTube page and it shows all of the recordings from this year's webinars. There is an EOT 101 webinar we did in February that explains the EOT. I'll let either Candice or Melanie answer that, but it's if you're interested in the EOT, I highly recommend you watch that webinar and look at our website. There's really good stuff on our website about it, and I think it's straightforward once you understand it, but it's quite confusing until you do, if that makes sense. So I'll let someone else answer the question.
Candice, you comment on that one?
When you need to revalue,
Well, they're asking about, so the question is, do you not need to revalue when current employees are selling their shares in the EOT to new employees? But there is no share sale in an EOT.
It's just you don't own the shares, so there's nothing to sell. When you leave, you're like the trust still owns the shares, right? So it's an issue of what do you get out of the, like, in terms of drawings or distributions while you're there. While you're there, when you're gone, you just stop getting them. So not really a valuation need.
Exactly. So I just put a little note that there's a webinar on this, and there's that link you can go to.
Perfect.
Another question. Yeah, you go ahead, Shar.
No, I was going to say the same thing. There's another question in the chat from Miss A. What is the general, once again, apologies if I said your name incorrectly. What is the general timeline in months for a medium diligence valuation? Is a medium diligence valuation sufficient for securing financing from institutional vendors like BMO? Question mark. Feel free to jump in and elaborate as well if I've missed anything in your question.
So I think you're talking about Zyle, and then I'll get Candice to comment on if that's acceptable from a financing point of view. But I think you're talking about that estimate level, what I called on those. I'm sure you've read it in detail already, but it's the middle level diligence estimate level. It depends. I always struggle telling people how long it'll be, but I typically say 2 to 3 weeks probably from the time you provide the last bit of requests. But what you have to recognize is that there's usually a number of rounds of diligence requests that come from the evaluator. So sometimes the information we get back just yields a whole bunch of other questions. Sometimes it doesn't. So it could be an iterative process. But again, it also depends on how complex the company is, whether their financial statements have been audited, reviewed, or compiled, how good their records are, etc.
And then just extending on that, if you think of due diligence in terms of buckets, your financial due diligence, which Melanie's team would really dive into. But then there's also legal due diligence, which the legal team for the buyers will support with, and operational due diligence. Typically, if the employees are key and involved in the business, likely they understand the operations. So guiding through that financial piece and the legal side can take a while. And we think, having Melanie's team as a guide through the evaluation is very critical. There's also this financial literacy piece. So for the employee buyers that are potential buyers that are coming in, having time to steep in that new information to understand it and think about the questions that they're going to want to answer before they make a decision on whether this is the right transaction for them, especially in a non-EOT type of transaction. That can take months. Sometimes we set expectations that this is going to take perhaps up to a year. And then when the bank gets involved, the lenders will also they'll rely heavily on the valuation that is done. They'll request a lot of additional information. The banking process itself can take, around 2 months, perhaps even longer, depending on how the business is trending year to date, and the information, just the time to gather the information, which Melanie says, once you have all the information, you can start. But the process of gathering and having that information ready and presentable itself is a big part of the project.
Yeah, and that's why it's really important to talk to someone like Candace, because she's gone through it before, and a lot of people misjudge how long that'll take with the financing, and because the lenders have to go through they have to do a lot of steps. They've got to go to credit or investment committee to get approval, so it takes a while.
Thank you.
We've got two questions, Shar. I answered your question in the chat because it was a little more specific, less specific to this webinar and more general to EOTs. But maybe
Evan?
Evan and maybe Rachel's question at the same time, and let Candace and Melanie answer them and then stop there since we've got 5 more minutes.
Okay, perfect. So I think Evan's question was, I understand many ESOPs normalize share price over a 5-year period. What should we consider in getting to our formula for calculating share price? I think you should consider getting a good valuator. That's my answer. It's not straightforward. I'm happy to talk to you more about it. It's not that straightforward.
I like that answer.
And then with that
Thank you.
valuator, understanding the triggers that would trigger you to get a refresh on that valuation, critical changes in the business. The evaluator will guide you on if these types of metrics or growth rates or scenarios evolve. That's a good alert that the past approach might be moot and a new valuation may be required.
Awesome. Rachel, you want to finish us off with one final question?
Or it's actually more of a complement of information just to the question of like, do you have to do evaluation when the employees exit? So I just wanted to just confirm a little bit what was said in the chat is there is the possibility to share equity as well as profit sharing in EOTs, but in the transactions that have happened so far in Canada, most of them are doing one model, but you do have the flexibility there. And in that case, for example, it's a bit of a mix of the US model of the ESOP. So in those cases, you do need to have something called an individual capital account. So you're tracking the share price, even though there's not an actual sale of the share, you're tracking the share price throughout that transaction. So I think the question is more, in those cases, I think it's going to go to a little bit more like an ESOP. How do you value? And in those cases, you probably set up a formula that you would reevaluate every few years. So you wouldn't have to do evaluation every year. That's one of the issues with the American ESOPs is they have to do evaluation every year. We don't have that in Canada, but you would have to have a formula. So just to answer the question, it is possible to do within an EOT, but in the first few transactions, no one's attempted it yet. So we're going to see how that's going to work when the first transaction EOT does the individual capital accounts.
Awesome. Thank you, Rachel. So with that, I think we've got 2 minutes. I'm tempted to take another question, but I'm not going to. This was so great. Candace, Melanie, thank you so much for being here, for sharing your expertise, and for answering those questions. We will post this recording so folks can watch it again. If anyone came in late, you'll be able to watch from the beginning. And where slides are available, we will also post those to our website. Feel free, to reach out with any questions, and just note that our website has a lot of really good information on it. So if you're curious about EOTs or ESOPs, there's a lot of information on there. And I recently went through and read most of it, and it's quite thorough and helpful. And if you need help with sell side transactions, valuations, employee ownership transactions, you should reach out to Candace and Melanie.
Thanks, everyone. Thanks for having us.
Thank you.
Thank you so much.